Hey everybody, David Lenevieux here with Rockmore Wealth Management. This week we're going to continue our two-part series talking about life insurance. Now if you remember last week we talked about who needs life insurance and how do we figure out what's a reasonable amount of life insurance. Now that we figure that all out, what type of life insurance should we be looking for? Because there are many different life insurance products that are available to be purchased, and many of them are very complex and difficult to understand. So I'm going to try to simplify a couple of those today for you. Now I'm going to break it down into two general types of insurance. First one is term insurance, and the second one is permanent insurance. Now term insurance is a very simple product. Basically what happens is once you're approved, let's say for a 10-year term insurance contract, the life insurance company will provide you with insurance for as long as you pay the premium. And in most cases, that premium is very inexpensive and it's level over the term of your contract. So if you had a $500,000 term 10 insurance and maybe you're paying $30 a month for it, well, you will continue to pay $30 a month for that over the 10 years. Now the question becomes, what happens when that 10 years is up? In some cases, that contract would expire and you wouldn't have life insurance anymore. But in most cases, the life insurance company is actually going to say, hey, you know what? We're actually going to automatically renew your insurance for another 10 years for $500,000. However, it's been 10 years, so we're not really sure how healthy you are anymore. So we're going to have to charge a premium. So instead of $30 a month, we're actually going to charge between $200 and $300 a month. Now, most people in that situation are going to go, whoa, I don't want to pay for this anymore. And you don't have to. At that point, you could cancel your contract, or what most people would do in that case, if they still needed the insurance, they would just reapply, assuming that they're healthy, they're going to get a much reduced rate, so they're not going to most likely pay $200 or $300 a month, but reasonably they're not also going to pay $30 a month anymore because you are 10 years older, so it's a little bit more risk to the insurance company. And that's how almost all term insurance contracts work. And you can get all types of terms. You can get 5-year term, you can get 10-year term, 20-year, 25-year, 30-year term. You can also get a term to 100 contract, and in this case, that's actually a permanent type of life insurance because a term to 100 contract allows you to pay a level cost of insurance for the rest of your life. And as long as you continue to pay that insurance, once again, the insurance company is obligated to provide you with a death benefit should you pass away during that time period. So your beneficiaries would receive that money 100% tax-free. Now, there are also other types of permanent insurance. And the ones that are most familiar are universal life and whole life. Now, universal life is a very complex product. You can pay level costs of insurance with universal life products. You can also pay costs of insurance that are yearly increasing. And I'm not going to go too much into universal life because they are a very complex product and they're only relevant for very specific situations in my opinion. Now, the whole life product is also a form of permanent insurance. And this can be beneficial to people that want permanent insurance because it allows them in some cases to pay for a certain amount of years and then stop paying in the future, because what happens with most whole life contracts is you participate in the earnings of the insurance company. And the way you participate is if the insurance company does well, they will pay out what's called a dividend. So they'll pay out some of their earnings per year to all their policyholders. Now this dividend is never guaranteed, but in most cases, most life insurance companies have never missed a dividend payment in over 100 years. And the beneficial part of most whole life contracts is you pay that level cost of insurance. Now don't get me wrong, the cost of insurance is much higher than term insurance. However, if you pay it for usually 10 to 20 years, at some point during that time, you can actually do what's called an offset or stop paying for that policy. And as long as the insurance company dividends still do fairly well, you're going to have permanent insurance for the rest of your life that you no longer have to pay for. and it's going to slowly accumulate some cash value, and actually the death benefit will generally increase over time as well. Now, this is a very oversimplified situation of how whole life insurance works, but it can be a very good option for a lot of people that want permanent insurance. Now, what type of insurance should most people get? Once again, I'm going to oversimplify this and make a whole bunch of assumptions, but let's take a young married couple that just had a child and bought a house recently. Because what you want to do when you're considering what type of life insurance to buy is you want to match the term of your liabilities to the term of your insurance. So what do I mean by that? Well, if you remember last week when we were determining the amount of insurance somebody would buy, we were considering what type of liabilities we had. And one of those was their mortgage. Well, most mortgages are amortized over 20 to 25 years. Now, another liability that we identified for most people was their children. So how long is that child going to be dependent on you? Well, if they're newborn, we're hoping it's only going to be 20 to 25 years again. Now, in some cases, it could be longer or shorter, but in general, we'll call it about 20 years. And one of the other liabilities we talked about was income replacement. So how long is my spouse going to need to rely on me to continue paying or continue working and paying the bills if something should happen to me in the short term? So most of these liabilities actually have, in this case, a 20-year lifespan. So in this general assumption, I would maybe make a recommendation that for the majority of your insurance, you get a term 20 product. Now, if that's not affordable, you could always jump down to a term 10 product. It will be cheaper. Now, it might not cover you over the whole course of when you need that life insurance. However, you could pay a lower cost of insurance for 10 years. And then assumably, if you're still healthy after 10 years, you could reapply, get another 10-year term insurance, and do it again. But I try to take risk off the table in these cases, and that's why I would look at a term 20 product. Now, we covered our short-term liabilities, and reasonably, the only liability that we weren't able to match was the one permanent liability that we always talk about, and that's the cost of death. Now, everybody out there has a permanent liability because we can never escape death or taxes. And when you do pass away, there's usually a tax consequence as well. And we talked about that last week. So in that case, when it's appropriate, you may want to consider having some permanent life insurance for that part. And remember, when we were estimating what our permanent liability was, we simply said take the higher income earner salary and divide it in half. So if that young couple, the higher income earner was $100,000, then they have a $50,000 permanent need. Now, it may not be appropriate just simply due to budget to get that permanent life insurance at the start, but that's always something we can address in the future. And these are the typical scenarios that we'll recommend to most individuals. Now, there's lots of other scenarios where we have our high net worth people and they have a much larger tax liability that's known early on, or we do have individuals that want to guarantee that they pass along a certain amount to the next generation. And that, of course, would once again be addressed with a permanent form of life insurance in the form of term 100 or whole life. But in general, these are the types of scenarios you will see. So once again, in the case of when you're looking at buying life insurance, look at what your liabilities are and try to match the term of your insurance to the term of your liability. Guys, that's it for my talk on life insurance. There's way more to go into if any of you have further interest or have questions on the subject. You know where to find us, www.rockmorewealth.com, and give us a shout. I'll look forward to speaking to you guys in the near future.